Hello everyone, my name is Divesh Harpalani, and if you are an ACCA skill level student planning to appear for financial management exams in March 26 or beyond, then this video is for you. This is the third lecture of our batch for March 2026 attempt for financial management. The first two lectures have been already uploaded to the YouTube and the link is given in the description below. So if you've not watched the first two lectures, please go and watch the first two lectures and then in continuity you can watch the third lecture. In the last lecture, we had discussed or we had started the chapter 3, which is investment appraisals, that is the discounting cash flow techniques. We had covered the concepts of time value of money, compounding, the reverse of compounding, which is discounting, the concept of cost of capital, net present value, perpetuities and annuities. And we were going to continue today's lecture with the concept of internal rate of return, So before I go into the technicalities of the concept, just intuitively ask yourself, when you make, let's assume your cost of capital, for example, if you've borrowed money from the bank to make an investment and your cost of capital is 7% and you make an investment somewhere and your NPV is positive. Let's say you invest 10 lakh rupees and your NPV is positive 50,000. What does this imply? This implies that you should make the investment because the NPV is greater than 0. But what does this imply? This implies that the cost of capital is lower than what you are making from your investment. That the interest rate or the rate that you are earning from your investment is much higher than the 7% rate, which is why it is giving you a positive value. Had your cost of capital been higher, your NPV would have been lower or 0 or negative. So what is the actual return that you are earning on the investment that you've made? That actual return is nothing but internal rate of return. What is internal rate of return also called as? It is also called as the effective rate of return or the DCF yield. This DCF, of course, is the discounted cash flow. So DCF yield or the yield rate. Yield is actually the amount that you get or the earnings that you get. So if your cost of capital is actually 7% in my example, but if you've hypothetically earned 10%, so you borrowed from the bank and you said, I will invest in the stock market where I've earned a higher number and that higher number is 10%, then this 10% is nothing but your internal rate of return. And in my example, when I told you that NPV was positive 50,000, which means your actual return would have been higher than 7%. So if you now discount your cash flows at the actual return, then this NPV will become 0 because your now discounting rate and the rate which you're actually getting is the same. So the present value of all future cash flows will be 0. But if your cost of capital is lower, which is 7% in this example versus the actual rate which you are earning of 10%, then there'll be a positive NPV from a 7% perspective. So what is the rate? The rate at which the discount rate at which the NPV equals to zero, because eventually that is the actual rate using which all your future cash flow can be discounted to present value. In other words, and like I had told you, the opposite of discounting is compounding. So effectively, if that is the rate and the investment gives you a 10%, then what this means is your investment is compounding at 10%. That is the rate which is called as the internal rate of return, which is the actual rate that you're earning on the investment, which is the actual rate, and hence this is the effective rate, the rate at which the NPV of the project is 0. And at this IRR, the cash inflows, of course, in present value terms, the present value of cash inflows is equal to the present value of cash outflows. And of course, so what is the formula of NPV? The formula of NPV is present value of cash inflows minus present value of cash outflows. And if at IRR the NPV is 0, then the present value of cash inflows has to be equal to the present value of cash outflows. It represents the percentage return that the project earns it represents the percentage return, which on our example is 10%, that our share market investment is going to give to us. Now, how do you decide? In NPV, of course, the way you were to decide is, if the NPV is positive, you would make the investment. If NPV is 0, you are indifferent, you may make the investment or you may not make the investment. And if the NPV is negative, you decide not to make the investment. How do you decide the same in IRR? Keep the concepts aside, just intuitively think that if what you're earning from the share market is higher than the rate at which the bank lends money to you, the bank, and of course in this example, cost of capital is the rate at which the bank lends money to you. We will understand the cost of capital in details in the future chapters on how it is determined. However, coming back, intuitively, if your share market return is 10% and a cost of capital, which is the bank loan rate, is 7%, then it is higher rate. And of course, this is the investment that you will accept, because at this NPV is positive and your IRR of 10% is higher than your cost of capital, which in our example was 7%. So which in our example is 7%. So 10% is higher than 7%. Now, if for example, stock market gives you only 5% return versus bank charges 7% from you, what do you now do? Of course, sir, why will we earn only 5% but pay 7% to the bank? Are we earning for the bank, or actually are we paying the bank from our pocket? It will happen that way if the investment gives lesser than 7% return, and hence such an investment you will directly reject. Sir, but what if the share market investment gives me exactly 7% return that the bank is charging from me? Then, sir, you are indifferent. You're getting 7% from the share market, you're paying to the bank 7%, so there's nothing left in your pocket, so you are at break even. There is a no profit, no loss situation. However, what this means is the IRR at the break-even rate is if you borrow exactly at the IRR. If you borrow, in our example, if you are borrowing at 7% and your IRR is 7%, then you are break even. Then your project cash flows are just enough to cover the cost. You do not get the cherry on the cake. 10% over 7%, the 3% extra is the cherry on the cake. But if you are earning only 7% from the share market, then in that case, your IRR is equal to the cost of capital and you are break even. Now, how do we calculate IRR? NPV, of course, we've understood how to calculate. You'll discount all the future cash inflows at your cost of capital, which is your discounting rate. And at that point, the present value of cash inflows minus the present value of cash outflows gives you your NPV. How do you calculate the IRR? So, for example, and keep aside the formula. If, for example, your NPV at 50,000 is 10%, NPV at 10% discount rate is 50,000 rupees, and at 15%, of course, the higher the discounting rate, we've learnt in the NPV concept that the higher the discounting rate, the lower my present value will be, because the discounting will be higher, and hence, in other words, think of it as you have to invest a lower amount to earn very high returns. In other words, if you have very high returns today, you will have a lower amount. So your NPV will be negative if your discounting rate is high, if you're borrowing at a higher rate, and if your discounting rate is lower, then your NPV is higher. So you are given two NPV scenarios. Now what do you have to understand? So sir, at 10% rate, my NPV is 50,000 positive. At 15% rate, I am at a negative 10,000. What do I do? What do you need for IRR? You need the rate at which your NPV is 0. You studied interpolation in your high school, in your higher secondary. How would you calculate this? It is a simple interpolation formula, which is nothing but the lower rate, in our example, the lower rate is 10% plus the NPV at this lower rate. What is the NPV at this lower rate? It is 50,000. The NPV at this lower rate of 50,000 divided by the NPV at this lower rate again, which is 50,000, minus the NPV at the higher rate. What is your NPV at the higher rate? Remember, it is not 10,000, it is minus 10,000. It is minus 10,000 multiplied by the higher rate. the higher discount rate, which is 15% minus the lower discount rate, which is 10%. The lower discount rate, which is 10%. So in this example, 10% is my lower discount rate, 15% is my higher discount rate. NPV at my lower discount rate is 50,000 and NPV at my higher discount rate is minus 10,000. How do I solve this now? This is 10% plus 50,000 divided by what is it? You have to calculate first and then watch my answer. Most of you would have calculated 50,000 minus 10,000, which is 40,000. No, this is already minus and this is minus. Minus will be plus. So it has to be 50,000 plus 10,000, which is 60,000. There's a common mistake, multiplied by 5 minus 10%, 15 minus 10%, which is 5%. So 50,000 divided by 60,000 is 0.83 into 5%, which is nothing but 4.17%. So your answer over here is 14.17%. So your formula of IRR is nothing but the interpolation method. You have NPV at a lower discount rate, you have NPV at a higher discount rate. You have to find the rate at which NPV becomes 0, at which NPV equals to 0. That is the rate of IRR. This is the classic interpolation that we used to do. The lower rate NPV, the higher rate NPV. What is the rate at which the NPV is 0? How do you solve it? You calculate NPV at one discount rate, that you calculate NPV at the other discount rate. Then you apply this IRR formula and then you check if the values are fine, which is IRR should be between lower and higher. Of course, over here, if you have both positive values, then your IRR will be slightly higher than both of these values. Then your IRR will be, for example, if you had a number of 12%, and I'm just putting a random number, this is not mathematically correct. If at 12%, your NPV was 30,000. If at 12% your NPV was 30,000, you can still solve the equation using 10 and 12%. But over here, unlike where between 10 and 15 your answer is somewhere in between, because one NPV is negative, one is positive. Here both NPVs were positive and hence your answer will be beyond those two range. But for easier calculation, generally try one NPV which gives you a positive, one rate which gives you a positive NPV, and one rate which gives you a negative NPV, So this is the concept of IRR. However, if we were to calculate IRR for annuities, what are annuities again? Annuities are annual cash flows. The same amount that you keep getting every year. Think of it as a Netflix subscription. I know Netflix subscription, some of you would have subscribed to the monthly package, some of you would have subscribed to the annual package. That is nothing but the annuities, which is the constant annual cash flows. Now for constant annual cash flows, we've studied this concept in the last lecture, but for IRR, how do you calculate using constant cash flows? Let's study this using an example. If your initial investment is 15 lakh and if your annual cash flows are 7 lakh for 3 years, how do you calculate? What was our formula? Our formula, if you remember, was present value is equal to future annual cash flows multiplied by the annuity factor for the rate and for the n number of years, correct? Now, if I was to find out the annuity factor, then this becomes nothing but present value divided by annual inflows, correct? What is my present value here? Present value is nothing but the initial investment of 15 lakhs divided by annual inflow of 7 lakhs. What does this number give me? This is nothing but 2.1428. This is an annuity factor for how many years? This is for 3 years. What is missing? Our percentage is missing. What do? We had studied the concept of annuity tables in the last lecture. Let us go and look at the annuity table And let us go ahead and look at the annuity table. This is the present value table. Let us look at the annuity table, where we will look at the time period of 3 years. The time period of 3 years. But I cannot find 2.14 anywhere over here, because clearly this ends at 2.4. What we want is 2.14. So let's come to 11 to 20. Let's come to 11 to 20. Now if we look at this, then we find 2.140, which is at 19%. Sir, but we were looking at 2.1428. Yes, of course, that is the exact IRR that you'll get. So what this means is your IRR is somewhere between this number, because it is slightly higher than 2.140, but as the closest approximation, your IRR is 19%. Your IRR is 19%. So this is how you calculate IRR in case of annual cash flows being same, which is annuities. Coming back. So for annuities, you divide the initial investment, to get by the annual cash flow, to get the annuity factor. 2.1428 is nothing but the annuity factor, and this factor we will find in the annuity tables like we just did, and the column in which it appears shows the IRR. You know the row because you know how many years it is. The column in which it will appear is nothing but the IRR. In exam, you will be given annuity tables which you can directly use, or you can use the spreadsheet as well. What do we do in case of IRR with perpetual cash flows? What is perpetual cash flows? That go on for perpetuity. Much after you, me and the syllabus lives, it will go on for perpetuity. The cash flows will go on for perpetuity. Now, keep aside the formula written over here. What was the formula of perpetuity? Present value in case of perpetuity was nothing but annual cash flows, the annual cash flows into 1 by R. Do you remember this formula? Now, R is the IRR. So if you want to find the IRR, you will say R is equal to annual inflow divided by present value. Correct? So you don't need to mug up the formulas. You can simply think of the logic and you will be able to derive the formula. So the formula is nothing but your annual inflow divided by the initial investment. Initial investment is the present value of all future cash inflows. The example, one more example here. Your perpetual annual cash flows is 1600. Your perpetual annual cash flows is 1600 divided by what is the present value of initial investment? It is 20,000 rupees or 20,000 pounds as the case may be. So 1600 divided by 20,000 gives you your rate, which in this case is your IRR. So what this means is, for example, if you are to invest 20,000 pounds today in a bond that gives you perpetually an annual cash flows at the rate of 8%, then 8% is your IRR and 1600. Or in other words, if you are investing 20,000 in a company, in a bond, which promises to pay you 1600 every day, what is the actual rate that you are earning? The actual rate that you are earning is 8%. Now, of course, while doing all of this maths, it seems slightly complex, all the interpolation, etc. But when you actually do it in Excel, it's just one simple formula of IRR. I will actually just directly show it to you in my desktop. Let us look at this with one example. I'm opening a blank Excel. Yes. So let us take any arbitrary numbers. I have not thought through any numbers. I am just arbitrarily typing any numbers over here. So let's say in the first year, I invest 10 lakh rupees. I invest 10 lakh rupees in the first year. In this at year 0. So this is year 0. This is year 0. And in the first year, let's say I get 1,50,000. Second year, assuming I get 2,50,000. Third year, I get 3,50,000. Fourth year, I get 5 lakh rupees. And let's say fifth year, I get 6 lakh rupees. Let's say this is an actual project that the company is investing in, and these are the cash flows that the company ends up getting. These are the cash flows that the company ends up getting. I will just do this +1. Now, I will simply use the formula of IRR and just select all of these values. Just select all of these values and you get the IRR, which is nothing but 19%. But sir, you said at IRR, the NPV is 0. So and we check this actually using the NPV function that we had studied in the previous class. Remember, for NPV function, you will use only the future values and then separately add or deduct the initial investment. So you'll have to deduct the initial investment. What is the rate? The rate for us is 13.395%. The rate at which the NPV is 0. Over here, IRR is nothing but 19.395%. What are my year 1 to year 5 values? I will select all of those. This is the total present value of cash inflows minus, and the reason I'm doing addition is this is already a negative value, minus this. But sir, you said it should be 0, of course, because this is approximated. If I add further decimals or if I exactly give the reference of this IRR, then my answer will be 0. So the NPV, the IRR is the rate at which the NPV is 0. So this is how you use the spreadsheet. In exam, you can use the spreadsheet function where you can start with year 0. You can select the range with all cash flows and this function calculates IRR automatically. There is no need for linear interpolation and it calculates IRR perfectly. So it makes it easier for you, but it is important to know how the IRR gets calculated. Now, by the way, one pro trick, actually, why don't we go through the advantages and disadvantages of IRR, and I'll give you one pro trick. So we've studied advantages and disadvantages of ROCE, which is return on capital employed. We studied advantages and disadvantages of payback period, of NPV. Now it is time to study advantages and disadvantages of IRR. It considers the time value of money. This was a demerit or the disadvantage for ROCE and payback period, which did not consider the time value of money. But unlike those, this considers for time value of money because it uses a discounting rate. It uses a discounting rate to bring all the amounts to the present value. So it does consider the time value of money, which is more accurate than just simple percentage returns, which your return on capital employed will give you. Similar to capital employed, however, this is expressed as a percentage, so it is easier. When I gave you an example that you've borrowed money from bank at 7% and you've invested the money at 10%, it is easier to understand that you're clearly making 3% higher. So it is intuitive to all the finance managers, all the managers, that your cost is X and your earnings are Y, so you should accept, which is more intuitive than explaining the amount that you've derived through NPV. Remember, in the previous chapter, we had discussed that profits are opinions, cash flows are facts. Profits are like the promise of your parents to give you money of 20,000 next month, which you cannot use until you get it next month. However, cash flows are the money that you have in your hand. It is facts which you can use. So cash flows are objective, profits are actually subjective, which can be manipulated using accounting distortions. And hence, because this method uses cash flow, this is a much more reliable method. The concept of IRR is much more reliable. This considers the whole project life. Remember, in payback period, we said that it does not consider the whole project life because it will consider the cash flows only till the time when you get your capital back. Post that, whether or not you make money or not, it is not relevant. However, in case of IRR, it considers the profitability for the entire time period, and hence in a case where you're making profits at a later stage, IRR gives you the complete view. And what is the one objective of a financial manager? To make sure that those decisions are taken which maximize the shareholder wealth, and projects with a higher IRR than your cost of capital, higher earning than your borrowing rate, will increase your shareholder wealth, which makes it helpful to use IRR, and hence it aligns with all the corporate objectives. However, everything in life comes with a negative side to it. Everything in life is half empty, half glass full. So similarly, even IRR has disadvantages. What are the disadvantages of IRR? It is not an absolute measure of profitability. It gives you only a percentage. Now, think of it as an example where there are two friends of yours. One friend says, I have made 100% return in 1 month. Another friend says, I have made 2 lakh return in 1 month. Okay. Which one would you go for? Another one will say 2 lakh return in 1 month. First one will say 100% in 1 month. You will say, actually 100% looks more attractive to me. Why don't I go with him? And then when you ask him, how much did he invest? He will say, I had invested 100 rupees. I got 200 rupees at the end of 1 month. And this gentleman will say, I had invested 20 lakh rupees and I got 2 lakh, which by the way is still an insane return from a month perspective. Let's actually say he's invested 1 crore. Let's actually assume he's invested 1 crore. So he's earned 2% versus the first gentleman has earned 1%, but he's only earned 100 rupees versus this gentleman has earned 2 lakh rupees. Which friend should you trust? Intuitively, you would have gone with friend 1, but always listen to the friend who talks in absolute numbers and not just percentages, because a $1,000 at a 10% IRR versus a 1 million at a 10% is very, very different. And of course, 1 million at a 10% is better. I would say even a 1 million at a 8% is better than 1,000 at 10%. So this is not an absolute measure of profitability, and hence it cannot distinguish between scale and return. A smaller project can give you very high returns, but it is still a very small project where your absolute earnings will be very less, versus a bigger project can give you relatively smaller returns in terms of percentage, but your absolute earning will be much higher. So this method makes project prioritization difficult when capital is limited. Eventually everything in this life is limited, so is capital. So you have to prioritize where to invest your capital. Interpolation estimates can be inaccurate. Like you saw, we also used our calculator. We did some rounding off, so there'll always be some rounding off. For example, a 9.5% can be rounded off as 10. But in case of marginal projects, let's say if your actual cost of capital is 9.5 and you're earning 9.6, but you had rounded off 9.5 as 10, you will probably reject the one which was 9.6% return, even though it was higher than your cost of capital. If you rounded off as 10%, you will reject this, and hence this calculation could be inaccurate. And hence spreadsheet method, which is where you use Excel, is much more accurate. If you calculate IR using the interpolation method, it is not very difficult, and especially if you've learned from me. But always there is some difficulty. You have to use your calculator 3-4 times, unless you are of course using the spreadsheet method, which is just one formula. But it is time consuming without these spreadsheets, and hence it is complex to calculate. Non-conventional cash flows cause problems. Non-conventional cash flows cause problems, which is if, for example, you have paid money, you have a cash outflow at year 1, and then again you have cash outflow in year 3. In standard cases, what do? We have outflow only once. There's only one initial investment, and then every year you keep getting money. But what if you have invested in year 1, you have also invested in year 3? For example, there is a machine which you have installed for 10 years, which will give you returns every year. However, every 3 years, there is a major service required. So every 3 years, at year 3, year 6, year 9, you will have to spend for the service. So you will keep having outflows every 3 years, and you will keep having inflows every year. So there will be multiple outflows and inflows mixed, which can result into multiple IRR, and hence this interpolation method cannot be reliably used. And the spreadsheet may also fail or give unreliable returns. For example, for a project which has 10 million outflow at T0, 5 million at T1 inflow, and 3 million at T2 could have a IRR of either 8% or 25%. There could be 2 IRRs. By the way, I want you to take note of this one graph. Let's assume x-axis is rate is discounting rate and y-axis is NPV. What did I explain you earlier? The higher the discounting rate, the lower the NPV. So let's say your discounting rate being something, your NPV is lower, right? And as your discounting rate keeps reducing, in our example, let's say if your discounting rate is 15%, at 15%, your NPV was minus 10,000, correct? And at 10%, your NPV was 50,000. So what is this slope? This slope is nothing but a downward sloping down. Okay, oops, I should have connected this. This slope is, pardon my drawing, but this slope is a downward sloping curve because as your discount rate grows, your NPV keeps coming down. They have an inversely proportionate relationship. They have an inversely proportionate relationship. They have an inversely proportionate relationship. Inversely related, I would say. Inversly related. Inversely related. Now, what is IRR? IRR is nothing but, actually the previous drawing was fine. The previous one was fine because at 15% it should be here. Okay, so this is the rate. This is the rate where, this is the discounting rate where the NPV is 0, where the NPV is 0. And what was this rate in our example? This rate is the IRR, which was 14.17%, which is the first example that we solved. The rate at which the NPV is 0, that is the IRR. This was 14.17%. So this is the downward sloping curve. This is the ideal scenario where you will typically have the IRR at this x-axis, because at this point your NPV is 0. However, in some cases your NPV, you will have an outflow in year 1, and then you'll have an outflow in year 0, and you'll have an outflow in year 3, and so on and so forth. So you could have a shape which is something like this. Why would you have a shape which is something like this? In, for example, year 1, you would have a positive cash flow. Then in year 2, you would have a negative cash flow again, for example, where your NPV will become, this is where your NPV is negative. And then again with your increasing cash flows, your NPV keeps going positive. What this means effectively, this is one IRR and this is another IRR. So there will be multiple IRRs. There could be multiple IRRs. Is one drawback of IRR as a concept. Going back, do take note of these two graphs though. Click a picture or click a snapshot. Coming back, the IRR assumes that the cash flows are reinvested at project's IRR. Effectively, what this means is, if let's say T0, T1, T2 and T3, every year you keep having some positive, let's say 200 rupees, 400 rupees and so on and so forth. Let's say your initial investment was 250 rupees. Let's say your IRR is, and I'm putting some random number over here. Let's say your IRR is actually 35%, right? Now what happens is, let's say you found a brilliant investment in an IRR is 35%, where you discount all your cash flows at 35%, and here your NPV is equal to 0. Let's assume that was the case. What this effectively means also is, the other way, you could also, what did I explain to you? That the opposite of discounting, if this is discounting, which is the arrow towards here, if you actually compound everything at 35%, let's say at T5, this is some number that you will achieve at the end of 5th year. This is some number that you will achieve at the end of 5th year. So you will compound 100 rupees for 4 years. You'll compound 200 rupees for 3 years. You'll compound 400 rupees for 2 years, and so on and so forth. So what IRR achieves is 35% is the rate at which 35% is the rate at which you keep earning interest or income from T1 to T5, T2 to T5, and so on and so forth. However, However, in real life, if there is one project that earns a 20% IRR, it may still earn only 10% from T1 to T5, T2 to T5, T3 to T5, and so on and so forth. However, IRR assumes that your cash inflows are reinvested at the project's IRR, which over here is 20%, over here is 35%. However, NPV does not have this flaw, because NPV uses the discounting rate which is same as your cost of capital, which is your borrowing rate. So it assumes that you will reinvest your money at borrowing rate, which assumes that you will reinvest your money at the borrowing rate, and hence your true wealth as in, let's say, the amount that you will make at the end of 5th year can be overestimated if you are to look at the IRR. However, if you look at the NPV, it will give you a more accurate measure. Now, using IRR, you can not compare mutually exclusive projects reliably. Let's say there is one project one. First of all, what are mutually exclusive projects? Which is either you can do project 1 or you can do project 2. So let's say you have a project 1. Let's say you have total 5 lakh rupees with you. Project 1 will take an investment of 3 lakh rupees. Will take an investment of 3 lakhs rupees but earn you 20% return. Project 2 will take the entire 5 lakh rupees but earn you, let's say, 17% return. If you were to look at IRR, you will say, I will probably go ahead with the 20% IRR, and you will ignore the one where you can make 17% at 5 lakhs. However, in this project, you can invest your entire money, or absolute earnings will be higher. Let's assume if this is a 1 year investment, you will earn 60,000 rupees, which is 20%, and over here 5 lakhs into 17% would be 85,000. So if you would have gone for project 2, you could have made the 85,000 versus you will say, oh, 20% is higher than 17%, and hence I will go for project 1. But the right answer over here would have been project 2 if only you would have used the NPV method. So this is one flaw in IRR, which is while comparing mutually exclusive projects, the higher project may actually have a lower NPV, and NPV is superior basis the project selection. This is one classic example. So IRR has this one flaw which NPV does not. Now, so we studied ROCE, we studied payback, we studied NPV, we studied IRR. Clearly, between the four, the first two don't seem so right, because, and again, everything has its own use, but the first two do not make use of time value of money. They do not discount these cash flows. However, NPV and IRR make use of time value of money, consider the entire project life. So it looks like both NPV and IRR got good to use. But between the two, what should we use? Because of the problem that we just discussed, NPV hence is the better or the superior one. Why? Because between mutually exclusive projects, between project 1 and project 2, where you have to choose only one between the two projects, which is build factory A or factory B, but not both, then what do? If it has different IRRs and NPV, then you choose the one which has a higher IRR NPV. For example, there could be a lower IRR of 15%, in our example 17%, but the NPV is higher than the company's cost of capital. At the company's cost of capital, NPV is 500k. At the higher IRR, the NPV is actually lower at 300k. Now remember, what is the objective? The objective is to take decisions that maximize the shareholders' wealth. It is not to choose a particular percentage. Remember this example of your friend. Will you choose 100% or will you choose the 2% here? You will choose the 2% here because your wealth gets maximized. So to maximize your wealth, you have to keep this one objective in your mind, which is you have to maximize the shareholders' wealth, which is why you have to make use of the one where your NPV, the absolute amount that you make, is much higher. So every time you have to pick the NPV which has the higher NPV. And why is NPV superior? Because it shows the absolute increase in the shareholder wealth. And what is your objective? Your objective is to increase shareholders' wealth, which creates more wealth. NPV respects company's cost of capital. It has already considered cost of capital. It has assumed that 10% is my cost of borrowing, and hence it is already considered your company's cost of capital. It does not have the reinvestment problem. The reinvestment problem that I told you from T1 to T5, T2 to T5, it will assume that it is doing it at the cost of capital, at the borrowing rate, versus your IRR will assume you'll keep getting the high interest rate, which is often unrealistic. One project may still give you high returns, one share may still give you really high returns, but will all shares will give you high return? The answer is no, and hence this is a more realistic, reasonable assumption to take, that NPV will invest the cash at the, which NPV takes, which is investing the cash at your cost of capital. IRR can often mislead on scale issues. Again, the same example of the friend that I gave, a 15% return on 10 million investment may be preferable to a 18% return on the 500k investment. So a smaller investment but higher IRR does not matter, because eventually what you have to see, what is the true litmus test? The true litmus test is what makes you the highest amount of profit. This is highest amount of wealth. This is nothing but the one with higher NPV, which NPV captures and IRR does not. In short, the decision rule for mutually exclusive projects, the mutually exclusive projects where both are either or, that's one of the two investments that you make, you have to always use NPV and always use the one with the highest possible NPV. Even if, by the way, two projects have positive NPV. What was the decision making in NPV that we studied? That if a project has greater than 0 NPV, has a positive NPV, you have to go and choose that project. But if you have two projects to choose from, you choose the one with the highest NPV. But this of course assumes that the projects are independent. You can do only either or, and the cost of capital is reasonably estimated. However, if there are two projects which are not mutually exclusive, which you can undertake both, if you can undertake both projects, then give me 1 second. If you can undertake both these projects, then what do? You go with this logic, which is if IRR is greater than your cost of capital, if NPV is greater than 0, then you accept both the projects. If let's say in this example, we did not have 5 lakhs, we had 10 lakh rupees and we could undertake both projects, we will go for both projects, because both have a positive NPV and both have a higher than, let's say your cost of capital was 10%, both have a higher than your cost of capital IRR, both have a higher cost of capital. So this summarizes our chapter 3, which is investment appraisal using discounted cash flow techniques. And now the one Joad, or the easy way to remember is, if you see across all the advantages and disadvantages of return on capital employed, payback period, NPV, IRR, all have few common points. What are those common points? Let's actually use a fresh note. The common points are: 1, time value of money. You should actually make this one chart for yourself so that you don't have to mug up. If I was to say ROCE, payback period, NPV and IRR, time value of money, these two consider, these two don't consider. Second is project life. Project life, this one again similarly these two would consider, and so on and so forth. What are the other parameters? Simplicity. The first two are simple, the latter two are not. Simplicity or complexity. 4, 5. If you will look at this, all of these will eventually, all of this easier to understand. Percentage or absolute. Some of these have an advantage that they are percentage, but they have a disadvantage that they are not absolute, and vice versa. All your advantages and disadvantages will likewise get summarized. So just look at the common points, create this tick cross table, and you will not have to learn the advantages and disadvantages of all of these 4 methods separately. This one table, as long as you have the conceptual understanding, this one table will summarize everything. Now let us just solve 2 or 3 master sums. At the end of every chapter, I have given questions for practice, which you have to do yourself. However, there are certain questions which are master questions, which we will be solving live in the class, which are master questions which broadly summarize all the concepts that we have studied through the chapter. These are the questions that we'll be solving live in the class, and the other questions you can practice by yourself. I have also given solutions for each of these practice questions and the examples at the end of this chapter. Of course, as you can see, this has chapter summary and exam tips, which effectively gives you all formulae, all the common mistakes that people make, and which you should remember. So the last 2-3 hours before the exam, if you want to revise, you can directly look at the chapter summaries and the key formulae. I have personally made these notes to ensure that our last 2 days revision and the last 2 hour revision also is sorted. Like I said, I have given solutions for examples and all practice questions. So I want you to solve all of these questions by yourself and then check the solutions. Coming back, let us solve the master questions. The first questions, and this actually is a quite easy one. It's a very easy one, but let us just solve it, summarize all the concepts that we've learned in the class. Number one, a 15-year annuity. What is annuity again? Annuity is annual cash flows. A 15-year annuity of 300 starts at once, immediately, commencing immediately, starting at once. What does starting at once means? Starting at once or immediately means starting today, We had studied in the last lecture that in such scenarios where we are starting immediately or starting at once, in such cases you have to consider the first cash flow at T0, which is today. So in this case, question 1, a 15-year annuity of 300 is starting today. If it is starting today, then it is nothing but a 14-year annuity, which is 14-year from T1 plus T0, because the value of 1 rupee today is of course 1 rupee. So you will use the 14-year, which is 15n minus 1, 14-year annuity starting T1 plus the T0 cash flow. So what is the T0 cash flow? Cash flow is 300. In other words, why don't we use the 14-year annuity factor of 6% 14-year plus 1 because the value of rupee 1 today is rupee 1. Let's just look at the annuity table. Just go to the end of this chapter. This is the annuity table. 6% and 14-year 6% is 9.295. So 9.295 plus 1 into the annual cash flow into 300. So 9.26295 plus 1, which is 10.295 into 300 10.295 into 300 is nothing but 3088.5, which is the present value, which is your present value of annuity, 15-year annuity, which is starting at once. In exam, English is equally important as math. Because you need to understand whether the cash flows start today or 1 year later. If you were to consider 15-year annuity, the answer would of course have been different. 2, you can solve by yourself. Number 3, which is a perpetuity of 33,000 commencing immediately. What is the formula of perpetuity? Perpetuity, the formula was the present value as per perpetuity is nothing but 1 plus R into annual cash flow, correct? 1 plus R into annual cash flow. However, in case of perpetuity which is starting at 1, starting today, we have to add the annual cash flow for year 1. If you were to do this, effectively what this would be is 33,000 divided by R. What is R over here? 22% plus 33,000 of year 0. I'm sorry, year 0 as in of today, because the value of 33,000 today is 33,000. There is no need to do any discounting, and hence 33,000 divided by 22%, which is 1,50,000 plus the 33,000, the value of which is 33,000 today. The answer is 1,83,000. This is how we would calculate perpetuity. 1,83,000. Right? Now the next one will be question number 2, which is the next complex sum. You have been given cash flows of a project for 4 years. You are expecting a rate of return, your minimum expected rate of return. What does this mean? You as a company will invest only if a project is earning what? A minimum required rate of return or expected rate of return. What was expected rate of return? Expected rate of return was nothing but IRR. If we go back to the concept of IRR, we had studied that IRR has an alternate name which is called as effective rate of return. So in exam, you remember that even if they ask you what is the effective rate of return, that is IRR. So they are saying your IRR should be minimum of 17%. If it is lower than 17%, what would you do? You would reject the investment. If it is higher than 17%, you will accept the investment. Now, these are the cash flows. You have to first calculate the NPV of the project if the cost of capital is 15%. Now, there's two ways to calculate. Of course, the first way is you can do 1 divided by 1.15, if you remember, which is 0.8696. You press equal to, again you will find the second year discounting factor at 15%, which is 0.756. Similarly, third year and fourth year. The other way is you use present value table. You use the present value table of 15%, 0.870, 756, 658. We also have to calculate in the sum NPV at 20%. So which are the values over here? So 0.870, which is, if I was to consider discounting at 15%, what is the rate? Of course, year one present value of ₹1 or discounting rate of ₹1 for year 1 is 1. For year 0 is 1. For year number 1, it is 0.870. Next year it is 0.756. Third year it is 0.658. Next year it is 0.572, which is 0.572. This is discounting if you do for 15%. What is it at 20%? 833,694,579. 833,694,579, and last one will be 482. So this is 482. This is nothing but discounting at 20%. If you do this math, this of course first year will be 50,000. This is nothing but present value. I'm sorry, I am bad at drawing. Clearly I can not draw lines, or I cannot draw lines. So over here, the present value at 15%, not draw lines. समझने वाले समझ गए, line नहीं मार सकता. Coming back 15%. 18,000 into 0.870 is 15660. 18,000 into 0.833 is 14994. 25,000 into 0.756 is 18,900. 25,000 into 0.694 is nothing but 17,350 rupees. 20,000 into 0.658 is nothing but 13160. 0.579 is nothing but 11580. Needless to say, the value of 50,000 for year 0 will remain 50,000. The present value at 20% is this. Last one, 10,000 into 0.7572 is 5720. 0.482 is 4820. Now to add all of these, minus 50,000 plus 15660 plus 18900 plus 13160 plus 5720. So the NPV at 15% is nothing but 3440. Now if we do the NPV math at 20%, the present value is minus 50,000 plus 14994 plus 17350 plus 11580 plus, I hope you are doing the calculator and not just seeing my face, using the calculator, doing it yourself. The NPV is minus 1256. So the answer to this question is 3440. The answer to this question is 1256. Using the NPVs that you've calculated, estimate the IRR of the project. How do you calculate the IRR? First of all, the formula of IRR. So try to remember the formula of IRR. Lower rate plus NPV at lower rate divided by NPV at lower rate minus the NPV at higher rate multiplied by higher rate minus the lower rate. What is the lower rate here? The lower rate here is 15% plus NPV at the lower rate of 3440 divided by 3440, which is the NPV of lower rate, minus 1256, which becomes addition, and 20% minus 15%. So 15% plus 3440. By the way, this is easy math. I could have easily done it in spreadsheet, but I want you to understand what I am doing. I want you to follow each step so that you can do it in exam. I could have easily used the spreadsheet and found the answer, but I am doing it using a calculator myself so that you figure out. This is higher than 3440 because minus minus means plus. This is 5%. So 3440 divided by 4696 into 5% is nothing but 3.67%. We will round it off to single decimal. So the answer to your IRR is 18.7%. This is equally important in the exam. Do not forget that on financial grounds alone. What does this mean? There could be a multiplicity of other factors. There could be competition, government policies, labor laws, so on and so forth, which are non-financial grounds to accept or reject a particular investment. But solely on financial grounds, should you accept it? Should you accept it? What did the question say? The question said the minimum IRR, the minimum expected rate of return is 17%. Is this more than 17%? The answer is yes. And hence, on financial grounds alone, we should accept, since 18.7% is higher than minimum expected return of 17%. This is how you should write it. Going to the next question, next master question, which is, there are three distinct projects of which the cash flows, it is important to see, are you given cash flows in exam or profits in exam? You are given cash flows. So the cash flows of this project for 5 years is given for all 5 projects. In each case, the initial investment represents the purchase of a plant and equipment whose realizable value, remember FR, realizable value is 20%, which means the scrap value is 20% of the initial cost, which is receivable in addition. What does this mean? These cash flows do not consider the scrap value. And hence you have to add at the end of the life of the project. This is a master sum because you are asked to calculate accounting rate of return. Again, what is accounting rate of return? Accounting rate of return is nothing but ROCE. The alternate name of ROCE is accounting rate of return. Based on which method? There were 2 methods, if you remember, we discussed in lecture number 1. Which is the initial investment cost method. The second method is the average investment method. Remember my example, whether you are buying a car at 10 lakh, so is it the 10 lakh amount that you're investing, or is it the 10 lakh plus 14 lakh or the 4 lakh that you will get at the end of the day? And hence the average being 7 lakh, 10 plus 4 divided by 2. What is the average investment? That is the average investment of 7 lakhs. You have to calculate the payback period, the NPV using a discount rate, and you have to calculate the IRR. What I will do is I will calculate everything for project F. for project E and for project G. You should calculate yourself and check the answer in the notes if you have gone right, and then finally you evaluate which of the project you need to make, while that is not the question that is being asked. Starting with row C, everything for project F, right? What is the formula of row C? The formula of row C is nothing but accounting profit divided by average investment, because that is the method that you are asked to use, the average investment into 100, because it is a percentage. What is the accounting profit for you? Remember, you are given cash flows and not profits. What is the bridge between cash flow and profit? Typically, while there could be multiple bridges, the difference generally is depreciation. So why don't we calculate depreciation over here? What is the initial investment? The initial investment is 120, correct? It is of course 120,000, so it's 120, right? Everything in thousands. 120 minus the scrap value, which is 20%. The scrap value, which is 20%. What is 20% of 120? I don't think I need to use the calculator to do this math. I'm sure you also don't need to. It is 24, and hence the depreciation over the useful life is 96. Over the useful life is 96, correct? What is your accounting profit? And remember, this accounting profit is annual profit, but we had discussed that in case multiple years are given, you can total the cash flows, you can total the depreciation, the total cash flows less total depreciation. What is the total cash flows first? 260, 15 fours are 60 plus 200, 260 being your total cash flows minus your depreciation throughout your life of 96. This divided by what is your life? Your life is 1, 2, 3, 4, 5 years. This is your annual profit divided by average investment. What was the formula of average investment? Average investment was initial investment of 120 plus the scrap value of 24 divided by 2, the 10 lakh rupees of the car plus the 4 lakh rupees that you will get as scrap value. Let us do this math. 260 minus 96 is 164. 164 divided by 5 is 32.8. 32.8 divided by 120 plus 24 divided by 2. This is 72. So 32.8 divided by 72 is nothing but 45.6%. So the accounting rate of return for project F is 45.6%. I expect you to calculate for project E and G as well, and look the answer if it is correct in the solution. Any questions you have, we will definitely discuss in the query session that we have once a week. Payback period. What is the payback period? Payback period is essentially when do you get the money that you've invested back? When do you get it back? How much have you invested? You have invested 120. How much do you get every year? 15. In 4 years, you end up getting 60. So in the 5th year, how much do you have to get? 120 minus the 60 that you've already received. So in the 5th year, you have to get in the 5th year. So of course, this is 4 years plus. In the 5th year, remember the amount yet to be recovered, which is 60. 60 is nothing but 120 minus 60. What is 60? 15 into 4, 15 rupees per year into 4. This is, so 60 is yet to be recovered. Divide by the cash flow of the last year. What is the cash flow of the last year? 200? No. Students, do remember, this is an absolutely common mistake that everyone will make. The cash flow of the last year is not 200, but 200 plus this 20%, which is in addition to the cash flows given above. So it is 200 plus 20% of 120. There is a reason I called this a must sum. So 20% of 120. So 4 years plus 60 divided by 200 plus 24. 200 plus 24. So this is 4 plus 60 divided by 224, which is 0.267. What is 0.267 in terms of months? it is 4 years plus 3.2 months. Remember, ACC always says round off upwards. We do not trust you to pay the money earlier. So it is 4 years and 4 months. This is your payback period. This is your payback period. I don't think I have enough space over here, so I'm going to do C and D over here. C and D over here. Question number 3C for project F, NPV at 10%. NPV at 10%. By now I remember the values. Year 0, 1, 2, 3, 4 and 5. What is the cash flow? The cash flow of each year minus 120 for first year. Of course, this is in thousands. Do not forget to mention that this is in thousands. This was 15, 15, 15, 15, and fifth year was not just 200 but 200 plus 24, which was the additional scrap value, so 224. What is the discounting at 10%? Now one can individually write it for each year, but a smart student will say, sir, this is annuities. Sir, this is annuities. Same cash flow every year. So 10% for 4 years, 10% for 4 years from the annuity table. If you look at 10% for 4 years from the annuity table, it is nothing but 3.170. And if we look at the fifth year present value, it is 0.621. So we will say, sir, for the first 4 years the cash outflow is the same. So for the first year of course it is, for year 0 it is 1. For next 4 years you will use the annuity table, which gives you 3.170. But for fifth year, sir, the cash flows are different. What do we do? For fifth year you will go and look at the present value table. 10% in fifth year will be 0.621. So this is nothing but 0.621. Now you do the math. The math is, what is the present value? Minus 120. Of course 120 rupees today is worth 120. Then 15 into 3.170 gives me 47.55, and the cash inflow in the last year is 0.621 into 224, not 200, 224, common mistake which people make. So 139.104. Now if I was to find the NPV, which is nothing but the present value of cash inflows, present value of cash inflows minus present value of cash outflows minus the present value of cash outflows. What is this number? This number is 66.654. This is nothing but the NPV. This is nothing but the NPV at 10%. Now you also have to find the IRR. So how do I find the IRR? One, I will give you the easy way. The easy way is this is, by the way, 66.654, but remember this is in thousands. What this means is, the answer is 66,654 is your NPV at 10%. This is also a common mistake that people forget, that it is in thousands. What will be the IRR? For IRR, sir, one easy way, you use the spreadsheet. Another way is you find out NPV. You find out NPV at any other rate. You could find out at 15%, you could find out at 20%. In this case, I have the value at 20% already, which is 8.9k. So 8.9 thousand, which is at 20%. Now if I was to use the IRR interpolation formula, I will say, sir, lower rate 10%, sir, NPV at lower rate, which is nothing but 66.654, sir, NPV at lower rate 66.654, sir, NPV at higher rate 8.9, correct, 8.9k, because everything is in thousands, into higher rate of 20 minus lower rate of 10%. To the math. In this case, 8.9 is a positive value. it is a positive value because IRR is even higher than 20%. This is one of the examples I had given in this class itself, that there could be a possibility that both your rates are actually below the IRR, in which case both of these will be positive, and hence this is nothing but 57.754 because I've subtracted 8.9 from 66.654 into 10% is nothing but give me a second. So 66.654 divided by 57.754 gives me 1.154 into 10%. So 10% into 10%, which gives me 0.115, which is nothing but, say 10% plus 0.115, so 10%, this is not 0.115%, this is 0.115, which means 11.5%, which is 11.5%. So my IRR over here is 21.5%. Like I said, this is higher than the 20% because even when I increased the discounting rate from 10% to 20%, my IRR was still, my NPV was still positive, but I had to further increase the discounting rate to make sure NPV reaches zero, because at the IRR, NPV is equal to 0. At this IRR, if you do the math, NPV is equal to 0. So this is the master sum that we have solved using all the 4 methods. What are the common mistakes? Again, you might forget to add the scrap value to the last year. This is a common mistake that people make. Can end up making. And second common mistake is that these are cash flows and not profits. Correct? Sounds good? The next question. Which of the following statements about NPV and internal rate of return methods are correct? An investment with a positive NPV is financially viable? Yes, because we had said if the NPV is positive, you should accept the investment. Fair enough. NPV is a superior method of investment appraisal to IRR. We discussed it as a superior method. Yes, because with NPV, you will come to know what is the total amount of wealth that is getting added to the shareholders' wealth. In case of IRR, that number may be lower, and hence NPV is the superior method. The graph of NPV against discount rate has a negative slope for most projects. The graph may have a downward slope or negative slope. The answer is yes. So this is also correct. NPV is the present value of expected future net receipts less the cost of investment. So present value of all future cash inflows less the present value of all future cash outflows. The answer is this is also correct, and hence all the 4 are correct. So the option is D. Question 5. A company is considering, and this is an interesting one, this is a very important one, it's a very tricky one also. Company is considering a 2-year project which has 2 annual IRRs. If you remember, I had told you a situation where there could be 2 IRRs, where there could be 2 different IRRs because the cash flows are non-conventional, where there could be 2 or 3 different IRRs because the cash flows are non-conventional. So what happens? This has 2 IRRs, 10 and 25%. The sum of undiscounted cash flows is positive. So there are 2 IRRs, 10% and 25%, correct? Now this is NPV. The sum of undiscounted cash flows is positive. What does undiscounted mean? When the discounting rate is 0, NPV is positive. So the NPV is 0 when the discounting rate is positive, correct? Which means the graph will go like this. The graph will go like, let's redo this bit. The graph will go like this, where this is 10%, correct? So it will form a U, which means at more than 10%, at more than more than 10% but less than 25%, when the discounting rate is, let's say 15, 20, 25%, the NPV is less than 0. This is an area where NPV is less than 0. But when discounting rate is higher than 25%, NPV again becomes positive because it is above 0. At 25%, NPV is 0 because 25% is IRR, the rate at which NPV is 0. At 10%, again, NPV is 0 because it is also an IRR where it is 0. What does this mean? The project will necessarily have a positive NPV at an annual cost of, when does it have positive NPV? It has a positive NPV at 0%, the answer is yes. It has a 0 NPV at 10, but between 0 to 10, the answer is yes, it will be a positive NPV. Between 10 and 15, the NPV is negative, the NPV is less than 0. And beyond, you should actually take notes of this, you should write it down in your notebook. Beyond 25% IRR, the NPV will be positive because at 25% the NPV is 0, and hence more than 25%, yes, your NPV will be positive. More than 10% is your NPV positive? The answer is no, because 10 to 15 it is negative. Between 10 to 15 again it is negative, so this is wrong. Less than 25, no, because between 10 to 25 our NPV is 0, so the answer is A. The project will necessarily have a positive NPV when the rate of return or the discounting rate is greater than 25%. It will have a positive NPV. Draw this diagram in your notebook. That summarizes our chapter. We are done with chapter number 3 with the questions, all examples we've discussed in the class, master questions we've discussed. Beyond this, you need to practice questions. Of course, there will be further questions that we will be solving from our question bank. There will be a separate question lecture that will get uploaded from the entire investment appraisal perspective, which is chapter 2, 3 and 4. There's another chapter on investment appraisals with specific nuances around tax and inflation, which is right after this, and we are just starting. But right now we've completed chapter 2 and chapter number 3. All the concepts we've covered, questions, there will be a separate lecture that will be uploaded. Let's now directly start with chapter number 4. So continuing with chapter 4 now, which is nothing but the further aspects of investment appraisal using discounted cash flows. It's the further aspects. Effectively, there are some nuances of inflation, taxation and working capital that this chapter tells us about. And of course, when we do the proper question lecture where we just solve questions about investment appraisal, there'll be no chapter 2, 3, 4. There'll be just one section of investment appraisal with all the concepts that will be missed in that one master question or master sum, which anyways we will do the questions we will solve in the next lecture. But right now, let's just understand the nuances of this. Before that, every chapter has the standard student guidance that you have to read all concepts, attempt all the examples, and then attempt all the practice questions without looking at the answers, which are also given at the end. There are also certain exam tip boxes that I have given, and towards the end of this chapter and every other chapter, there are certain summaries and tips and tricks of the common mistakes that generally students make in the exam, so that when you have to revise the day before exam, that revision becomes easier. Without further ado, let's just get started. What is the impact of inflation? First of all, what is inflation? Of course, you would have studied in economics in childhood, but in simple terms, I will give you one example. In 1960s, the price of, just imagine what is the price of one teacup, in a restaurant, in a decent restaurant. If today you go to a restaurant, the price of a teacup is anywhere between 50 to 150. Some of the restaurants will even be selling it at 200, 300. But generally speaking, between 50 to 150, you'll get a good cup of tea in a restaurant. What was this price in 1960s? It was 15 paise. That 15 paise today has become 50 to 150 rupees. This is nothing but inflation. So inflation is the general increase in the prices which lead to a decline in the real value of money. We had studied in chapter number 2 that interest rate is a factor of 3 things. One of those three things is inflation. One of those 3 things is nothing but you expecting a return on the money. You're expecting a return of the money, which the example that I had given you, that think of it as you are giving money to someone and he's giving you rent in the form of interest. And number 3 was the risk. Inflation is one of those things. How does inflation affect interest rates is the question. So general increase of prices is inflation. Now, interest rates interest rates, you would have heard about GDP. GDP also, there is a real GDP and a nominal GDP. What does real GDP mean? Real GDP means that today's prices, or let's say at constant prices, at the same 15 paise, how much has the real GDP grown, which is how many, for the lack of a better example, how many cups of tea has increased in India. That is your real GDP growth. However, when we talk about nominal GDP growth, we will not just consider the number of cups that has increased, we will also consider the increase of 15 to 50. That is the nominal GDP. So real cash flow or real return is nothing but if there would have been no inflation, then how much of return you would have gotten. If you were to get 5% return, your 100 rupees becomes 105 rupees tomorrow, assuming the same pizza which used to cost today at 400 rupees continues to cost 400 rupees, the same dinner that you would go on with your date continues to cost 400 rupees, then the return that you expect is the real return. However, unfortunately, that date has to cost more expensive because there is inflation and there is a loss of purchasing power of money. Money today is worth more than money tomorrow, the same time value of money concept, but the reason here is inflation. The total rate is nothing but the money rate or the nominal rate, and hence the nominal GDP is higher than the real GDP. Similarly, the nominal rate or the money rate is higher than the real rate. However, let's take an example. If inflation is approximately, I'm taking a random example. If inflation is, for example, 4%, and for example, the real return that you need is, for example, 6%. Is my money rate 4 plus 6%? Is it 10%? The answer is a big no. Why? Because your 4% will also be calculated on the 6%, right? And similarly, your 6% will also be calculated on the 4%. So given this interdependence, I will actually retain this so that you remember that it is not a simple math. There is a Fisher formula which is given, which is nothing but your nominal rate, your money or the nominal rate is nothing but your real rate multiplied by your rate of inflation. H is the general inflation rate and R is the real rate. So in our case, my money rate would have been nothing but 1 plus 0.06, because 0.06 was my real rate of 6%, multiplied by 1 plus 0.04, which is inflation, and hence 1.06 into 1.04. The answer is not 10%. The answer is 10.24%. This is my money rate. There's another example given over here, which is if an investor requires a 10% real rate and the compensation for inflation is running at 5%, then it is not 10 plus 5, 15%, but you can do it two ways. You can do it in a step approach. First, apply inflation 100 into 1.05. Then you can apply the real rate, because your purchasing power now has, the 105 rupees will be needed to buy things worth 100 rupees. So you need return on not 100 but 105 rupees, and hence 1.1 into 105 is 1.15. In other words, your total increase is nothing but 1.05 into 1.10, which is 15.5% of money rate. If you were to apply this to 100, you would have anyways gotten 15.50. That is how the formula has been derived. How to remember this formula? The easiest way to remember this formula is nothing but think of one as a base bun. So in a burger, think of one as the base bun. So one continues to stay. Think of if one is the base bun, think of R as the patty in a burger. Is the patty in the burger, or actually think of inflation as the patty in the burger. Think of inflation as the patty in the burger, because inflation increases. It increases the prices of goods. So on the base bun, you apply a patty. On the base bun, you applied a patty. And then on this patty, your real rate is nothing but your cheese, the topping on top of the purchasing power that you need, the return that you need. This return is nothing but your cheese. So your base bun plus patty plus cheese gives you your money nominal rate, which is nothing but your burger. This is nothing but your burger. So this is nothing but your money rate. Now, in exam, there will be different terminologies that will be given. And like I said in the chapter 3 as well, in ACCA exam, it is equally important to know English as it is important to know the finance concepts and maths. Why? Because in the exam, if they mention that a particular cash flow is stated in today's prices, what does today's prices mean? If they were to say if that the tea is stated at 1960s prices, then it was to be stated at 15 paise, not at 50 rupees. So it is without inflation adjustment. You will have to do the inflation adjustment. However, if they say this is in a nominal cash flow, then they've already brought it to a 50 rupees of tea. They've already adjusted for inflation in the exam. So if they give you real cash flows, then the purchasing power of money is staying constant. They have considered it at the 15 paise, and hence there is no inflation which is included. So for example, if they say, and by the way, the default assumption in the exam is that the cash flows are money cash flow. What does money cash flow mean? Future cash flows in future purchasing power, not today's purchasing power, unless and until they explicitly tell you that it is in today's prices or in current prices. You have to assume that it is in future prices, not today's prices. So let us look at the first example. If it is sales in current terms, which means it is in today's prices, and it keeps inflating by 10% for every 3 years. Then what this means is, in year one, it will be 100 into 1.1, which is 110. Year 2, will it be 110? No, it will be 110 into 1.2, so it will be 121. Year 3, again 10% inflation, 121 into 1.1 is 132, approximately 132, 133. 121 into 1.1 is 133, 133.1. So that is your. However, if in the example they were to say the sales will be 100 in year 1, where they've already said it is 100 in year 1. If it was 100 in today's terms, which is in year 0, it is 100. Over here, they have said it is 100 in year 1. Then you have to inflate it from second year. Your year 1 will be 100. You have to inflate it by 10% in year 2. This is 110, and year 3 will be 121. So the difference, read the questions carefully. The difference is, if it is in current terms, which is at year 0, if it is 100 rupees, then you have to apply inflation even for first year. If it is in year 1, then the inflation for year 1 has already been factored in. Now there's two methods of handling inflation, but before that, I want to cover another concept. There's a concept which is general versus special inflation rates. Keep the concept aside. Let me talk about an example where, let's say, if you are a student who is staying in a mess, right? Who is not staying in a, actually students do stay in mess. But coming back, if you are a student who is staying in a hostel, right? And hostel has a mess, that's what I meant. If you're staying in a hostel, there is mess food. The prices of mess food year on year increase by 4%. Now, your pizza prices or your date prices increase by that famous cafe you wanted to take your date. Their prices have actually increased by 10%. There's a lot of demand. Or you actually travel from your hostel to your college in bus, to your college, school, wherever you want to go, office, you travel in bus. The prices of bus have actually not increased because they are subsidized. The government says we don't want to increase any prices. This differential 4%, 10% and 0% is nothing but specific inflation rate. What is general inflation rate? General is For the sake of simplicity, the average from a country perspective, government releases data of consumer index and consumer inflation. That is the overall inflation rate from an economy perspective. However, specific items have different inflation rates, which are specific inflation rates. What this means is the general inflation rate affects your overall required return, because you may require specific money to spend on specific things, but from an investment perspective it will give you a generic inflation rate, and hence it is used to link the real and the money cash flows. Again, it is used to link, this is effectively, real is the cheese and money is nothing but the overall bread. You need the inflation rate, which is the patty, to create that burger. Specific inflation rate affects individual cash flow items differently. For example, in a business scenario, your wages, oh sir, आपने दिल की बात कर दी, your wages, your salary may increase at a lower number, but your materials, the cost of living, etc. may increase at a higher number. Your salary can grow at a snail's pace, even if your cost of living is growing at your date prices are going at higher. Coming back, wages could increase at a different rate and materials at a different rate. What do you do in this case? You first of all convert all the real cash flows to money cash flows. You will increase the mess food prices by 4%, which means mess food prices for next year will be, if today this year they were 100, then next year they'll be 104. Increase the pizza prices from 100 to 110 and increase the bus prices by 0%, so they will remain the same. So use the specific inflation rate to inflate, and then once you have inflated, now if first year you were spending 100 across mess, 100 across pizza and 100 across bus, second year how much will you spend? You will not spend 300, you will spend 104 for mess, you will spend 110 for pizza. But sir, looks like I may not be able to afford the pizza anymore. Keeping that example aside, 110 for pizza and 100 for the bus. So next year your total spending will be 314 rupees. But sir, my investment gave me only the inflation rate. Keeping aside the real rate for a moment, it gave me only the inflation rate, which is the average, which is for example 5%. Then your 314 rupees divided by this becomes your or let's say if this number was hypothetically 3%, which is general inflation, then 314 divided by 103% will become 304 rupees. So, but sir, I had only 300. I would have had to invest 304 rupees. What does this imply? This implies that the prices have actually increased to 304 rupees worth today. But today you have only 300 rupees, which means you may not be able to afford that pizza that I spoke to you about, because the items that you are spending on have a higher inflation rate versus the overall inflation rate. Coming back, actually I will keep this example. So what you will do is, your first step is to increase the current cash flows to money cash flows using the specific inflation rate, and then you deflate. What did I do? I deflated the 314 by 3% to using the general inflation rate. This is nothing but the general inflation rate. And the current cash flows would have been real cash flows. The current cash flows would have been real cash flows only and only if the specific and general inflation rates were the same. This 300 and this 300 would have been same if mess would have increased by 3%, if bus would have increased by 3%, and if pizza would have increased by 3%. But because it is not the same, in this case, current cash flows and real cash flows are not the same. So you have to take a longer route. You have to go from current cash flow to future cash flow, money cash flow using the specific inflation rate, and then you have to bring it back, the money cash flow, you have to bring it back to the real cash flow using the general inflation rate. Now coming back to the two methods of handling inflation. There is one method where it is simple. You have the cash flows in real terms. If you have been given the cash flows in today's prices, if the question says that the cash flows are in today's prices at T0 at year 0, then you don't then you don't do the hard work of converting real cost of capital, then you don't do the hard work of converting real cost of capital to money cost of capital. You just use the cash flows in real terms to convert it to real cost of capital. You go with the easier way, which is you simply use the real method. However, this is possible only if one inflation rate applies to all the things and there is no tax. We'll come to the tax later, but if there is no tax and if only one inflation rate applies, if mess, bus and pizza all three have the same inflation rate, then and if your cash flows are given in real terms, then you can directly use the real cost of capital and convert. However, if that is not the case, then you have to inflate each of these cash flows with a specific inflation rate. Like in our example, all the three, pizza, mess and bus, inflate it using specific inflation, then deflate it using the money cost of capital, which is nothing but something that you will find using this formula, which is your burger, The money or nominal rate is your burger, which you will use to discount. This is something that you will use when different inflation rates apply, when tax is involved, or there is any combination of these two. So the golden rule is RR, not Rajasthan Royals. It is real method, real rate, money method, money rate, MM. RR, MM. Think of it as two different roads, but leading to the same cafe, leading to the same place of date. Two roads, but same destination. The answer will be the same. So when is each method preferred? If there is one inflation rate and no tax, then you can use either, but real is faster, so use real. If there is annuities and perpetuities one rate, which means annual cash flow, and there is only one rate given, again use real, which is similar as situation 1. But there are multiple inflation rates, then you use money method. If there is tax involved, then you use money method, because real method becomes too complex. Now let us just solve the first example so that you can understand this better. Telco is evaluating project A, which requires an initial investment of 50,000. Expected net cash flows are 20,000 per year for 4 years at today's prices. What does this mean? This means that today's prices means this is real cash flow. Because, and this can be considered as real cash flow because there is only one inflation rate given, there is no two inflation rates given. But if there are specific inflation rates, different inflation rates, then it cannot be considered as current cash flow being real cash flow. These are different things. So let us find out using the money rate method. They have given you the money cost of capital. First of all, we need to find the real cost of capital. But what is the formula of money cost of capital? The formula of money cost of capital, 1 plus I, is 1 plus R, which is the real cost of capital, into 1 plus H, which is inflation, correct? Which means 1 plus R is nothing but 1 plus I divided by 1 plus H, correct? Simple math. Which means if your money cost of capital is 1.15, which is nothing but 1 plus 15%, then your real cost of capital will be 1 plus R into, what is your inflation that is given over here? The inflation they have given is 0.055, which is 5.5%, correct? So your 1 plus R is nothing but 1.15 divided by 1.055. What is 1.15 divided by 1.055? It is nothing but 1.09. So 1 plus R is 1.09. So your R becomes 9%. This is your real cost of capital. This is how you actually use the formula, correct? Now, does our work end here? The answer is no. This is the start of the sum. Find the NPV by using the discounted cash flows using the money rate. So, are these cash flows money cash flows? No, sir. These are real cash flows. That is the first question. Are these money cash flows? No, these are, sir, real cash flows. That is the first question. These are current in today's prices. These are current cash flows. These are real cash flows. These are not nominal cash flows. So you will have to first of all convert these to nominal cash flows. So what is the real cash flow? This will be the nominal cash flow. This will be the discounting at money cost of capital, which is 15%, which is the nominal rate also, and this will be the present value. This is how we will solve the sum. I am trying to improve my line marrowing skills. Oops, clearly not working. But anyways, so for first year, your real cash flow is 20,000. Your real cash flow is 20,000. Is your nominal cash flow different? No, sir. In first year, there is no impact of inflation. So nominal and real are the same for first year. So first year, there is no time value of money concept. First 1 rupee in the first year is 1 rupee. So discounting factor is 1 rupee. And hence my present value is also 1 rupee. Sir, in year one, actually this was 50,000. My bad. This was 50,000. Again, this was okay. Sir, in year one, my real cash flow is 20,000. Sir, by the way, can I use annuities method in money rate? Sir, no, the answer is no, because I have to first increase this 20,000 to factor in inflation of, so I'm doing 20,000 into 1.055, which gives me 21,100. Again 21,100 into 1.055 gives me 22,260.5. The third year, this will become 23,484.8. But the real cash flows remain the same, 20,000. Correct. This is year 2, year 3 and year 4. This remains the same at 20,000. Now one more time, this will be nothing but 24,776.5. Correct. Now the discounting rate at 15%. We will go to the present value tables. Let's just go to the present value tables. I'll give you this at the start of your book so that you can easily look at it whenever you want to. At 15%, first year, second year, third year, fourth year, first year, second year, third year, fourth year, 0.870, 756, 0.870, 0.756, 0.6, what is it again? 0.658 and 572. 658 and 0.572. I am not using the calculator because I have already calculated these values on the side. I am just writing these numbers. You can use the calculator and calculate it at your end. The number is 16829. The number is 15423. The number is 14172. What is your NPV, sir? My NPV is nothing but the total of all of these cash inflows plus this cash outflow. This number is 14811. This number is 14811 plus minus because of some rounding off, but this is the number. This is my NPV using money method. Now, why were we not able to use annuities method? Because, sir, the annual cash flows are different, so the annuity method cannot be applied. Now let us use the real method. The real method does not mean the real method and this is the fake method. Real method means the method using the real cash flows and the real rate. Now this is very simple. Year 1, 0, 1, 2, 3, 4. Real cash flow is nothing but minus 50,000, 20,000, 20,000. Oops, too many zeros. 20,000, 20,000, 20,000. Correct. What is my discounting rate? Now my discounting rate has to be at the real cost of capital, because like I said, RR, real cash flow is real cost of capital. So this will have to be at 9%. What is it at 9%? At 9% present value table, 9% present value table, or actually I can use annuity table over here. I can use the annuity table over here because the cash flows are the same. At 9% for 4 years, it is 3.240. It is 3.240 till the 4th year. This is minus 50,000. What is my present value? My present value is minus 50,000. What is this? This is the annuity factor. What is 20,000 into 3.240? It is 64,800. It is 64,800, and hence the answer is 14,800. This rounding off, there is a difference over here, 14,811, 14,800, because annuity factor tables are rounded off to the third decimal. If you would actually do it one by one, the answer will be exactly the same, and hence NPV using real method is the same as the NPV using the money method. However, given you had real cash flows in this question, B is simpler to do. So RR and MM both are possible things to do. However, when you have no inflation, just one inflation, you don't have any specific inflation and no tax, you can use either, but real rate is faster. That summarizes our example 1. Example 2 you can do by yourself. It is literally the same thing with different numbers. This concept we have discussed. So with general and specific inflation, if your price amount is 5,000 in the second year, your specific inflation means 5,000 into 1.06 raised to 2, which means your 5,000 rupee that is costing 5,000 today, current value will cost 5,628 in future. But at that point in time, the overall inflation in the country would have been 4%, which means the real cash flow would be different. You will divide it by 1.04 because that is the general inflation. Like I said, you convert the current cash flows, the mess amount, to the specific inflation rate, and then you deflate it using the general rate, which means this is your real cash flow, which can then be discounted using the real cost of capital. This is the real cash flow, means this is the amount it will be costing in today's prices. Finally, which method do you use? You use real method or money method if there is only one rate and no tax. But if there are multiple rates or tax, then you have to mandatorily use the money method. Inflate at the specific rate and then discount at the money rate. Inflate everything at the specific rate 4, 10, 0, and then deflate using the general rate. Let us solve one example. So this project has the following cash flows. Again, this is cash flow, not profit. Before allowing for inflation, which means these are stated at today's values, current values. These are current values. But are these real? These are not real cash flows because the inflation rates are different. When the inflation rate has a specific inflation rate, current is not equal to real. So these are current, not real. Now, the company's money discount rate is 15.5%. The general rate of inflation is expected to remain constant at 5%. The general rate, actually, sorry, my bad. This is the second example. This is the second example. This, guys, you have to solve. We were supposed to solve the third example. This is your homework. You have to solve it. I already started doing it for you. I'm glad I stopped in between. You have to solve it yourself. So example 3, where the company is considering a cost saving project, and this involves purchasing a machine costing 7,000 rupees, which will result in an annual savings in real terms. In today's terms, the annual savings will be 1,000 for wages and 400 for materials in today's prices, which means in tomorrow's prices there will be a higher savings. What is the inflation? Sir, over here actually the salary is increasing faster. Superb. So the inflation for wages will be higher. The inflation for material will be 5%, but the general inflation is 6%. This, for example, is your mess. This, for example, is your pizza. And this is your general inflation rate. So you know what to do. You know what to do, which is very, very easy. What we will do is, and by the way, these are the savings. These are the savings. What are they saying? They are saying, sir, I will buy a machine which will actually automate my work. I will not have to work. I don't need people. I don't need materials. And hence I will have a saving. So what NPV does not always mean current cash flow has to be cash flow in money. It can also be an opportunity cost, which we had studied in chapter 3. What are relevant cash flows? Sir, relevant cash flows could also be opportunity cost, sir. It could also be opportunity cost. Actually, we had studied this in chapter number 2, but I think it's important to go back so that you all remember that these are relevant cash flows, could also be opportunity cost, So remembers, I should have also remembered, is what you'll be thinking. Yes. So so the relevant cash flow, so there will be a savings, which means there will be a cash this is pseudo cash inflow. This is considered as cash inflow every year. Now first doing it for wages. Year 0, is there any saving on year 0? Of course, today there will be no saving. If I put a machine today, it will take 1 year to give me savings now. So year 0, there will be no saving in wages. Material, there is no saving in year 0, but my overall present value will have a negative 7,000 because there is an initial investment in the machinery. This is year 0. What happens in year 1? Sir, year 1, my wages become 1,000 plus 7%, 1100. Sir, second year it becomes 1210. Sir, third year it becomes 1331. Sir, fourth year, sir, what are you doing? What is 1210? Sir, 1100 into 10%, 110 is added to 1100. So this is nothing but 1100 into 110%. This is nothing but 121 into 110%. This is nothing but 1331 into 110%, and so on and so forth, which is 1464, and again 110%. This is 1611. I have rounded this off. What is it for material? Material 400 becomes, today it is 400. In a year's time, it would have been 400 into 1.05. So it would have been 420. Again into 1.05 would have been 441. Again into 1.05 would have been 463. Again into 1.05. Sir, this does not stop. Unfortunately, that's the reality. How do you think 15 paise of tea became 50 rupees of tea? 486 into 1.05. 510 rupees. So this is your total cash flow for each year. Total cash flow. This is what? This is money cash flow. This is the money cash flow for each year. What is the money cash flow, sir? Money cash flow is for first year 7,000. For second year it is 1100 plus 1420, which is 1520. So for third year it is 1651, which is 1210 plus 441. For fourth year it is, for third year it is 1331 plus 463. So this is 1794. For fourth year it is 1464 plus 486, which is 1950. Yes, I am learning. For last year it is 1611 plus 510, which is 2121. This is what, sir? This is money value, which is at the fifth year it will be costing me 2121 rupees, which means the same thing that today is costing me 1400 rupees, in the fifth year it will be costing me 2121 rupees. But in my case, I will be saving 2121 by taking this cost saving project. So there is an opportunity cost. Now, what is my general inflation rate? My general inflation rate is 6%. My general inflation rate is 6%. Is it relevant? Is it relevant? Yes, it is relevant because I have been given real cost of capital. What did I say? MM. If I have money cost of capital, my discounting should be done at money cost of capital. At money cost of capital, MM. And hence, what is my money cost of capital? Money cost of capital is what? My burger. It is my burger. So 1 plus R into 1 plus H. What is R? R is my real cost of capital, which is 8.5%. What is H? H is my general inflation of 6%. So 1.085 into 1.06 gives me 1.1501, and this is 1 plus I. So I becomes 15.01%. 15.01%. So what is the discounting rate? This is discounting rate of 15.01%. Discounting rate of 15.01%. For the sake of simplicity, 15%. I will look at the present value tables. Oops, there's a lot of scrolling down. Let us go directly to the last page. At 15%, we keep using the same number every time. So 0.870, 0.870. But sir, first year, it has to be 1. The value of rupee 1 in first year is rupee 1. So 0.870, 0.756, 0.658, 0.572 and 0.497. 0.497. What is the present value? Present value is nothing but the money cash flow into the discounting rate, which is 1322. So 1520 into 0.870 is 1322. 1651 into 0.756 is 1248. 1794 into 0.658 is 1180. Use your calculators. 1950 into 0.572 is 1115. This is 5. And then for the last year it is 1054. Now I will add all of this and subtract 7000. 1322 plus 1248 plus 1180 plus 1115 plus 1054. 5919 minus 7000. Oops, the NPV is negative 1081. NPV is negative 1081, which means, sir, you should not invest in buying this machine, because if you invest, sir, you will spend 7000, but you save only 1001. Do not invest, because present value of savings is lower than the present value of the investment, which means NPV is negative. So do not invest. This was our last sum. So yes, this is where we will conclude our chapter for today. Conclude the lecture for today. We will continue with this in the next lecture. Again, for those of you who've not enrolled but want to enroll, you have the link given in the description box below. You can look at the offering and you can decide after these lectures if you want to enroll. But for everyone, all the best for your exams, and for those who've already enrolled, stay tuned. Look at your app for the next lecture, which will be soon uploaded. All the very best to all the students. If there are any queries, please feel free to reach out to me. For any queries regarding the batch enrollments, look at the description box. There's a WhatsApp number. There's also a website link. Feel free to reach out. Thank you so much and all the very best. God bless you all. Hope you like this lecture. Thank you. Bye-bye.